The stock market is booming today after Donald Trump was reelected to be the 47th president of the United States. My combined portfolio is up 4.5%, and that is being led by stocks like Tesla, which is up 14.8%. My dividend growth portfolio is up 2.2%, and the S&P 500 is up 2.2%. So the stock market is reacting very well to a Trump presidency, and you even have Bitcoin up 8% on the day. So in this video, I'm going to share the top 5 stocks that will benefit from a Trump presidency. I'll explain the logic behind my picks and even do a brief stock analysis. But first, let's take a step back and look at the big picture. I did a full election prediction video and outlined how I think about investing going into an election. And I want to reiterate the main point of that video. You should not let politics impact your investing strategy. If your candidate did not win, and even if you disagree with what you hypothetically think their agenda may be, you still need to intelligently invest for your future. And fundamentally, you need to focus on increasing your own income and intelligently investing that money to grow over time. This does not change no matter who's in office. You have the most control over your own life. And when it comes to investing, all that matters is that the free market system of the United States would still exist. Businesses and individuals would continue to innovate and increase human productivity. And over the long term, there will always be opportunities to invest your money and build wealth, no matter if it's a Republican or Democrat administration. However, a president's policies does have real impacts on the economy and the world. As I mentioned in my election prediction video, Donald Trump's policies have a lot of positive impacts. For example, lower corporate taxes and deregulation boost corporate profits. And as we all know, over the long term, the stock price reflects the earning power of a business. So increased earnings is likely to drive up a stock price. I would also like to mention that in that election special video, I basically predicted exactly what would happen in the election. I said that Trump was likely to win all the swing states and had the potential to win the popular vote, which he has. But in today's video, I'm going to try and keep the politics out of it so that if you were pro-Trump or pro-Kamala or just anti-Trump, you will still be able to take away some value. So please do your best to be civil and respectful in the comments. But let's analyze the top 5 stocks to buy and hold during a Trump presidency. That will include 3 dividend growth stocks, 1 high growth manufacturer, which I think you may know, and other surprising companies. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using my stock analysis tool, dividenddata.com. We just released a new feature called Ask Dividend Data. It gives you access to an AI investment analyst. Think of this as ChatGPT, but trained to help you analyze stocks. You can learn about business models, identify key metrics, write investment reports, summarize earnings, and use a dynamic stock screener to filter by hundreds of metrics. And to celebrate the launch of this feature, we are doing a 50% off sale for dividenddata.com. Just use the promo code AI at checkout and you can get 50% off for life. Click the link in the description and pinned comment to sign up. But let's get to the video. So the number 1 stock I think will benefit during a Trump presidency is somewhat surprisingly Tesla. And the market seems to think so as well because they're up 14.7%. But the real question is why? On the surface level, there's the fact that Elon was vocally supporting Trump, and the Democratic Party has basically grown to hate him. So there was a lot of downside risk of political retribution against Elon Musk's companies, and now that risk has been eliminated. But that's really just the surface level, and I think there are some real policies that will benefit Tesla as a company and increase their earnings over time. First off, it should be noted that many of these things may not happen or will look different when they do happen. But while Trump was running, he had key proposals that would impact Tesla both negatively and positively. And here are a few. You had a lower corporate tax rate of 15% for companies that manufacture their products in the United States. How does that impact Tesla? Well, they are one of the largest US manufacturers. They have factories across Texas, Nevada, and California. Trump even had specific proposals around the car industry. That includes tariffs on Chinese electric vehicles and really any car car manufactured outside of the United States, particularly in Mexico. And the entire point of this policy is to incentivize factories and jobs to stay and be built in the United States. And this has already happened. Tesla was long planning to build a new car factory in Mexico, but they halted that last year when it seemed like Trump might win. And instead, they will likely just continue building more production in the United States over the coming years. And what's interesting about Trump's policies is they're actually aimed to help traditional car companies. For example, he wants to make sure there's no electric vehicle mandate. And if you follow this industry, you know that Ford and General Motors are losing massive amounts of money on their electric. So their transition to electric has been very bad economically, as they're basically switching from selling a profitable vehicle to an unprofitable one. And this is a little bit of that innovator's dilemma that happens in many different industries. Trump has also voiced getting rid of the electrical vehicle tax credit. And you would think that that is a negative for Tesla until you start to think about the competitive landscape more broadly. Tesla is the only profitable electric car maker, and they have the highest margins in the automotive industry outside of niche luxury cars like Ferrari. And over the past few years, Tesla has continued lowering the prices on their vehicles as they optimize their manufacturing and squeeze out costs. So Tesla is actually not reliant on this tax credit at all anymore, and their vehicles are competitively priced to even gas peers. But then you have competitors like Rivian who are losing massive amounts of money on every single car sold while having much more expensive vehicles. And then you have the traditional automakers with unprofitable and higher cost electric vehicles. So I think you'll have this interesting competitive dynamic where Tesla actually maintains and even grows their market share in the electrical vehicle market. And Trump had some other car-specific policies he was proposing. For example, he proposed allowing the interest on car payments to be deductible to an individual's taxes, and this would help make vehicles a little more affordable and induce demand. And for the legacy automakers, I think this will help put them in a better financial position, but these really have been bad investments for decades. They are no growth, low margin companies. In contrast, Tesla is a high growth, high margin company, and they have a much broader product portfolio across various technologies. So even if only a portion of these Trump policies come to fruition, Tesla is likely to grow at a high rate into the future. They were already expecting 20 to 30% vehicle growth next year, and it's important to reiterate that they are the only profitable electric vehicle maker. But of course, if you follow Tesla, you know that they are a much broader technology company, and it's not entirely about vehicle volume. Another big part is self-driving and AI. And now we're getting into a little more speculative territory, but I think it's very likely Tesla will face way less roadblocks on the rollout of full self-driving over the next few years. And I think quite possibly his relationship with Trump may lead to a federal approval across the United States. Of course, once it has clear and obvious safety testing. And the 5-year bull case for Tesla is all around self-driving and AI. So let's move off of Tesla. Another stock which is up big in my portfolio today is Visa, ticker symbol V. Visa is up 4.2% on the day. And this one is getting a little bit of a bump, maybe not for what Trump would do, but for what he wouldn't do. I covered in a video a couple months ago about a DOJ lawsuit against Visa. That lawsuit, if carried out, could have the potential to lead to various fines on the company. Go back and watch my entire video if you want my thoughts on that. But that was from the Biden-Harris administration. And now that Department of Justice will no longer be in power. So it's safe to assume that lawsuit will go away. And what that means is Visa will continue its track record of growth. The company has a major tailwind behind it as the world has transitioned to digital payments over the past few decades. That trend only continues. Visa is an incredibly high margin business with 77% gross margins and 55% net margins. Revenue per share is growing at a 13.5% 10-year compound annual growth rate. And that is the same for free cash flow per share. Visa is a dividend growth machine with a 17.2% 10-year compound annual growth rate. The most recent dividend increase was 13.46%, which was a slight slowdown. The payout ratio based on earnings per share and free cash flow is 21% and 22%. The Visa dividend is very sustainable and set up for high future growth. And this is a company continually growing cash flows over the long term, which will lead to increased stock price growth and return of capital to shareholders via their growing dividend and their stock repurchase program. In this example, Visa is not a company benefiting from a president's policies, but really benefiting from the lack of negative policies towards it. And in that exact same spirit, I'll do an honorable mention for Alphabet, ticker symbol GOOGL. And if you've been following the news, then you know that Alphabet is under investigation by the FTC, alleging that they are a monopoly. Now, what's interesting is that this started in the Trump administration, but for vastly different reasons, more over censorship of technology companies. And then that continued during the Biden-Harris administration. And the new FTC chair, Lena Khan, she brought more of a view to deconstruct these companies and break up the big tech companies. So with Google, it's less clear what's going to happen with them in the future, but they're still up 3.78% on the day. For stock number 3, I have Snap-on Incorporated, ticker symbol SNA. And the reason is that this is an industrial company which manufactures a lot of their products in the United States. And it has a pre-existing track record as a company with reliable high earnings growth and reliable high dividend growth as well. The 5-year compound annual growth rate of the dividend is 14.38%. And that's high growth with a 2.11% dividend yield. The dividend is also incredibly sustainable at a 35% payout ratio. This is really quite impressive. Snap-on is a company I was already looking at adding to my portfolio, which really goes back to a core point I mentioned at the beginning of the video. You should not be entirely altering your investing strategy based on who wins the presidency. A great company is a great company, so you need to make sure you have that part of the analysis correct no matter who's president. But Trump's policies may benefit companies like Snap-on. That's why the stock is up 5.5% today. They could potentially get that lower 15% tax rate for manufacturing in the United States. Also, they are a big tool and industrial company, so they'll benefit from a lot of industrial manufacturing and spend. So a potentially more protectionist economic policy around vital industries may help companies like Snap-on and their customers. I've been looking at buying Snap-on for my portfolio over the past few weeks, and over the short term, I may have missed the boat as the stock has gone up a good bit, but I do think over the long run, there may be opportunity to buy into this company again. And then on the surface level, we have another industry which is supposed to benefit from Trump's policies, which would be oil and gas. However, I think this is a lot less clear which companies will benefit. As you know, Trump has been going around with the drill baby drill slogan. So a big part of his policy is increasing oil and gas production and energy more broadly, and that includes approving new sites like Anwar in Alaska. So there's no doubt that at least the aspiration is to increase energy production, which will lower costs for Americans. Lower energy costs is not the best for many energy stocks. They have actually benefited massively from the high oil prices over the past few years, raking in crazy money during 2022, and currently we're still at very profitable levels around $70 a barrel. And we can just take a look at Exxon stock for one example of that. They had massive earnings per share during 2022, and they're still operating at very profitable levels. However, if you were to drive down oil and gas prices further, that would no doubt impact their earnings. So that would lower their margins, but the flip side is that increased production might increase overall revenue. And if we look at ExxonMobil historically, their revenue is actually not really at all-time high levels. So these oil producers will likely do fine, and there actually could potentially be a short-term buying opportunity sometime in the next 4 years if oil prices were to dip very low at one point. Profitability and margins may go down, but revenues will likely go up, and the overall importance and security of the industry will increase. And this 2020 view that oil and gas were going to go away will become further and further in the back mirror. That was obviously wrong then, and I used it as a massive buying opportunity. But I would not be buying oil and gas producers right now. So I'll give 2 other examples of how I would play the oil and gas trade over the next 4 years. One, I would look towards natural gas and pipeline companies because they get paid for transporting it, and the price of the commodity, whether it's oil or natural gas, does not matter as much. Also, the planned deregulation will likely lead to many more projects and constructions over the next few years. So there's potential for more pipelines if you keep your eye on it. I own Enterprise Product Partners, ticker symbol EPD, and I would have to do a lot more digging and research to really find what the best opportunity would be. So I asked my AI tool about what some of the best US natural gas stocks could be, and I filtered by dividend payers with over a 1% yield. And of course you have ExxonMobil and Chevron, which are both oil and gas companies. And then you have pipeline companies like I mentioned, like EPD. Other notable ones would be Energy Transfer, which currently has a 7.81% dividend yield, but it should be noted that they have a less consistent dividend track record, and they do not consistently increase it on an annual basis. You have other companies like Kinder Morgan, ticker symbol KMI. So there's a lot of potential research you could do, but I would really look into the pipeline companies. And aside from that, I would play the oil and gas sector from actually more of a land rights and royalties perspective. Texas Pacific Land Corporation, ticker symbol TPL, is a great stock I've had on my watch list for a very long time, and they boomed 6.23% today. And this is a really interesting company. They basically own a ton of land and natural resources in Texas. Their land and resource management segment manages approximately 880,000 acres of land. And they hold royalty interests in oil and gas production. So any oil and gas generated from their land, they get royalties on. And the reason why that is great is they don't have to front any of the cost or labor to make this production happen. And as a result, this company prints money. They have a 93% gross profit margin, 79% operating margin, and 66% net profit margin. In 2023, they made $350 million from oil and gas royalties, which was 56.5% of their revenue. They also made $112 million from selling water and $84 million from water royalties. And these oil and gas royalties will grow from increased volume, and they bear far less risk from lowered oil prices, reducing profitability. It's crazy how much the earnings per share and stock price has grown for TPL stock. This is one I wish I had my eye on much longer. And if I had bought this during 2020 when I bought ExxonMobil, oh my God, it would have been crazy. But I have my eye on this. If there's ever an oil and gas crash again, I am buying this stock. Revenue per share is growing at a 31.98% 10-year compound annual growth rate. Free cash flow per share is growing at a 30% 10-year compound annual growth rate. And while this isn't a consistent dividend payer, they do have a track record of long-term dividend growth and very large special dividend payments iterated throughout. They also use a lot of these profits to buy back stock. They are in a fantastic economic position with $1.2 billion of shareholder equity. They have $900 million of cash and cash equivalents and less than $1 million of debt, resulting in negative $893 million of net debt. As I mentioned, this company prints money from royalties with very little costs. All of that capital can get returned to shareholders. I have Texas Pacific Land Corporation, ticker symbol TPL, on my watch list. And finally, when I think about U.S. businesses who would benefit from lower corporate tax rates on American manufacturers and increased corporate profits, Berkshire Hathaway, ticker symbol BRK.B, would be a big beneficiary of this. This is Warren Buffett's famous investing company, and they're up 4.72% on the day, crossing $1.01 trillion of market cap. And they own countless American businesses, including Berkshire Hathaway Energy, which is one of the largest utility companies in the United States, and the BNSF Railroad. They are also in fantastic financial position with $325 billion in cash and short-term investments. Warren Buffett built this company to be a money compounding machine, and it will continue to be decades and decades after he's gone. A great business is a great business, and this will continue to be a great business over the next 4 years. And as I wrap up this video, I just want to remind everyone that you should not let politics control your investing strategy. If your candidate lost, do not get out of the market and sell. Throughout the past 100 years of American politics, that has always been a mistake. And what really matters is focusing on your own personal financial situation and your income producing skills, and then intelligently investing that money. And the same principles apply no matter who's in office. You're looking to buy fantastic businesses that will continue to grow into the future. And many of the stocks in my portfolio were going to do great regardless of if Trump or Kamala won. And a big part of that is continued technological innovation. The advancements in AI are real and are going to impact our economy in major ways over the next few decades. And I'm invested in a lot of companies that will benefit from that, whether it's Microsoft, Salesforce, Apple, Google, Amazon, etc. And I am optimistic about the future regardless of who won the presidency. So with that said, leave a like and subscribe to the channel if you enjoyed the video. If you want to use the stock analysis tool I showed throughout the video, then sign up at dividenddata.com. You can get 50% off and try our new AI tool. Use the promo code AI at checkout. Click the link in the description and pin comment. Thanks for watching.